Welcome to lecture number 6. In lecture number 6, we will discuss different accounting assumptions. The first and the basic most assumption of accounting is the monetary unit assumption. Monetary unit assumption ये है कि you only enter those transactions which can be measured in form of money. For example, आपने if you have bought inventory worth $300, then you will record this transaction as increase in inventory and decrease in asset or an increase in liability in the form of account payable. So this is what you call monetary unit assumption. The monetary unit assumption requires that companies include in the accounting records only transaction data that can be expressed in money terms. This assumption enables accounting to quantify economic events. The monetary unit assumption is vital to applying the cost principles. अब monetary unit assumption की वजह से बहुत सी ऐसी चीज हैं which you cannot enter in your financial report. For example, health of the company's owner that you cannot quantify, so you cannot write. The quality of service or the morale of the employees, these things you cannot enter in your financial reports as these things cannot be measured in terms of money. The second one is economic entity assumption. An economic entity can be any organization or unit in a society. Economic entity ये है कि the dealings of the business should be kept separate from the dealings of the owners, and the business should be treated as a separate legal entity. When we talk about economic entity assumption, we have different types. One is your proprietorship. Proprietorship is a business which is owned by one person. For example, if you have a small shop, so it is your proprietorship. The owner is often the manager, operator of the business. Small service type businesses, plumbing companies, beauty salons, and auto repair shops are all proprietorship in nature. Now, one important point which you should keep in mind when discussing proprietorship is the legal ownership. There is no legal distinction between the business as an economic unit and the owner, but the accounting records of the business activities are kept separate from the personal records and activities of the owner. So the proprietorship has no legal standing because it is not separate from the owner in legal terms. लेकिन accounting purpose के हिसाब से हम proprietorship की जो record keeping है, it is kept separately from that of the owner. Second one is partnership. Partnership also has no legal standing, but for the accounting purposes, it is treated as a separate entity. And a partnership is a business owned by two or more persons associated as partners in a partnership. In most respects, a partnership is like a proprietorship, except that more than one owner is involved. Corporation. Now, corporation is a separate legal liability entity. A business organized as a separate legal entity under state corporation law and having ownership divided into transferable shares of stock is a corporation. The holders of the shares, who are in fact the real owners of the company, are called the stakeholders or stockholders. And they enjoy limited liability. That is, if they are not personally liable for the debts of the corporate entity. For example, if you want to register a company in Pakistan, you will go to SECP. First, you'll get your name registered, and then your entity, legal entity, which will be a company, will be formed. The majority of businesses in the world, they are run as corporations. For example, you have Walmart, you have GM, General Motors. So all these big companies are corporation in nature, and they have separate legal entity and separate legal identity. Now, what is going concern? Going concern uh, assumption states that, and it means that the life of a business is limitless. It is, the definition is, uh, person will remain in business for an indefinite period of time. What it does, it provides perspective on the future of the company. For example, when we talk about the accounts payable and account receivable, we always take these things into the next financial period. Why? Because the going concern assumption states that the business of a life, that the life of a business is limitless. And this going concern assumption affects your assets, and it also affects your liabilities. It also affects your expenses. For example, when we talk about prepaid rent, now prepaid rent initially is uh, taken as a current asset, but as the business has a limitless life, so with the passage of time, you start consuming your current asset into an expense. Then we have what you do. I've given some other examples in this going concern topic as well, so you can go through those. For example, I will discuss one more example with you. If the going concern assumption has not been used for a particular set of financial statements, because of the threat of liquidation or bankruptcy, financial statements must clearly disclose that the statements were prepared with the view that the entity will be liquidated. The going concern also, now as I've told you, the going concern assumption also influences liabilities. If the entity were liquidating, some liabilities would have to be stated at amounts in excess of those stated on the conventional statement. Also, the amounts provided for warranties and guarantees would not be realistic if the entity were liquidating. And the going concern assumption also influences the classification of assets and liabilities. For example, without the going concern assumption, all assets and liabilities would be current, with the expectation that the assets would be liquidated and the liabilities paid in the near future. So whenever we talk about the financial statements, we always prepare the financial statements keeping in mind the going concern assumption. Now the next assumption is time period. The only accurate way to account for the success or failure of an entity is to accumulate all transactions from the opening of business until the business eventually liquidates. What we do, we divide the life of a business into different segments, which we call normally, a financial year or a business year. Some businesses select an accounting period known as the natural business year, which ends when operations are at a low ebb in order to facilitate a better measurement of income and financial position. In many instances, the natural business year of a company ends on December 31st. Other businesses use the calendar year and thus end the accounting period on December 31st. So normally the time period assumption states that the financial period of a company is for 12 months, which is known as the fiscal year. So what you do, whenever you make your reports, you always keep in mind a period of 12 months, and the reports that you make are based on those 12 months. Realization. Accountants face a problem of when to recognize revenue. All parts of an entity contribute to revenue, including the janitor, the receiving department, and the production employees. The problem becomes how to determine objectively the contribution of each of the segments towards revenue. Since this is not practical, accountants must determine when it is practical to recognize revenue. Now, revenue recognition means when does revenue become a part of your financial reports. So the normal method is the period in which you earn revenue, you mention the revenue in that financial year. For example, when you have sold goods, either it is on cash or it is on credit. So whenever you have sold the goods, so you have earned that revenue, and then that revenue can be taken to your financial reports. Now, what is matching? Matching concept is how you handle your expenses with respect to the revenue recognition or the realization of the revenue. The revenue realization concept involves when to recognize revenue. Accountants need a related concept that addresses when to recognize the costs associated with the recognized revenue. The matching, this is called the matching concept. The basic intent is to determine the revenue first and then match the appropriate cost against this revenue. Some costs, such as the cost of inventory, can be easily matched with the revenue. For example, if you sell cars and you have sold one car on, let's say, 5th of May. So 5th of May, you can enter that sale in your financial books. At the same time, you can also determine the cost of buying that car and include it in the financial period, same financial period. So that will be considered as the matching of the expense with the revenue that was generated. But there are some costs which have no direct connection with revenue. So some systematic policy must be adopted in order to allocate these costs reasonably against revenues. Examples are research and development costs and public relations costs. Both research and development costs and public relations costs are charged off in the period incurred. तो बहुत सी ऐसी cost होती हैं which can be directly connected to the sale. So वो cost तो आप you mention it with that revenue generation activity. But some costs you only do it once in your financial year. For example, the research and development, the marketing. तो वो आप उसको as annual cost treat करते हैं. Now, what is conservatism? The accountant is often faced with the choice of different measurements of situation, with each measurement having reasonable support. According to the concept of conservatism, the accountant must select the measurement with the least favorable effect on net income and financial position in the current period. Conservatism ये है कि you should always, try not to overstate your net income and your assets, and you should always try not to understate your expenses and your liabilities. For example, writing inventory down to an arbitrarily low figure in order to recognize any possible loss from selling the inventory constitutes inaccurate accounting and cannot be justified under the concept of conservatism. Then we have accrual basis accounting. As you know, we have two types of accounting. One is accrual based and one is cash based. Cash based accounting may you enter a transaction once you have received cash in it. For example, if you have made a sale on cash, only then that transaction will be entered in your financial statement. But accrual basis means you do it regardless of whether you have received cash or not. So now we'll do a small example. The following illustration indicates why the accrual basis is generally regarded as a better measure of the firm performance than the cash basis. Now, a company has sold merchandise inventory for 25,000 on credit this year. The merchandise cost 12,500 when purchased in the previous year. purchased merchandise this year in the amount of 30,000 on credit. तो ये 30,000 जो है ये बेसिकली आपने मर्चेंडाइज परचेज की इस करंट फाइनेंशियल ईयर में एंड यू पेड सप्लायर्स ऑफ मर्चेंडाइज 18,000 दिस ईयर. अब व्हाट डज कैश बेस से? Cash basis means that you only enter transactions for those you have received the cash. For example, when we go for the cash basis methodology, the receipts were 15,000. Why? Because you only receive 15,000 cash from your customers, and the expenditure was 18,000. Now, why the expenditure was 18,000? Because you paid suppliers 18,000. So your loss was 3,000. And when we go for accrual base, now according to the accrual basis, you only take into consideration not only the revenue recognition but also the expense matching. So the sale was 25,000. Sold merchandise for 25,000 on credit this year, and the merchandise cost 12,500 when purchased in the prior year. So cost of sales was 12,500 and the sales was 25,000. From this, we can say that the accrual basis indicates a profitable business, whereas the cash basis indicates a loss. The cash basis does not reasonably indicate when the revenue was earned or when to recognize the costs that relate to the earned revenue. The cash basis does indicate when the receipts and payments disbursement occurred. The point in time when cash is received and paid do not usually constitute a good gauge of profitability. However, knowing the points in time is important. So this is the difference between accrual basis and the cash basis of accounting. So what we have done in this lecture, we have gone through the assumptions which we take when we are doing accounting, and this will be the end of lecture number